It starts quietly, not with a bang, not with sirens, not with flashing red lights. Crises rarely announce themselves in the way movies and TV shows make you believe. In reality, the beginning of a financial disaster often feels boring, calm, even optimistic. The stock market might be hitting all-time highs. Unemployment numbers look great. News anchors talk about strong fundamentals and consumer confidence. People are buying new cars, booking vacations, remodeling their kitchens. Everything seems fine, right up until it's not. But here's the strange thing. There's almost always a pattern that shows up before the storm hits. You can see it in the years, months, or sometimes even weeks before a crash. And if you know what to look for, it's like seeing storm clouds gather on the horizon while everyone else is still sunbathing on the beach. This isn't some magic crystal ball. It's a collection of signals that have repeated throughout history in every major economic collapse. The trouble is, most people either ignore them or explain them away. Think about it. In 1929, just before the Great Depression, New York was a city of champagne, jazz, and skyscrapers climbing higher than anyone thought possible. Investors felt like geniuses because every stock they picked went up. In 2007, right before the housing bubble popped, people were buying second, third, even fourth homes, convinced that real estate never goes down. In early 2020, weeks before the pandemic would send shockwaves through the global economy, the stock market was at record highs and tech companies were valued like they could never fail. Every time the warning signs were there, but they were hiding in plain sight. The first sign is almost always euphoria. It's a strange word to use for an economic topic, but that's exactly what it is. A mass emotional state where people feel invincible. Euphoria in markets is like the first gusts of wind before a hurricane. It feels exciting, even pleasant, but it means trouble is coming. This is when you start to see people making financial decisions based more on emotion than logic. Strangers brag about their investment gains. Sure things become the talk of the office. You start to hear phrases like, "This time it's different." 4 words that should make every investor's skin crawl. The second sign is more subtle: leverage. When people and companies start borrowing more and more money to chase higher returns, it's like building a skyscraper on a foundation of glass. It looks strong from the outside, but one small crack and the whole thing comes down. In the 1920s, investors bought stocks on margin, borrowing huge amounts to amplify their gains. In the mid-2000s, homebuyers took on massive mortgages they couldn't afford, while banks bundled those mortgages into exotic products and sold them as if they were risk-free. The problem with leverage is that it works both ways. Just as it amplifies gains, it magnifies losses. And when things start to go wrong, the unwinding of that leverage is like pulling on a thread that unravels the entire sweater. The third sign is overconfidence from institutions. The belief that the system can't fail. This is when central banks, large corporations, and political leaders start making public statements downplaying any risk. They insist that growth will continue, that the fundamentals are strong, that there's no reason for concern. Ironically, these reassurances often happen right before the collapse. In 2007, the US Federal Reserve's chairman famously said that the impact of the subprime mortgage crisis would be contained. It wasn't. In 1929, prominent economists wrote in newspapers that the stock market had reached a permanently high plateau. That plateau lasted about 3 weeks before stocks began their historic plunge. The final sign, and the one that most people miss, is small cracks in unrelated places. Before a crisis, you often see odd disruptions in seemingly minor corners of the economy. A regional bank quietly fails. A niche commodity spikes in price. A small country experiences a sudden currency collapse. On their own, these events seem unrelated, even irrelevant, but they're like the first dominoes in a chain. They reveal stress in the system. Stress that's often hidden beneath the surface until it explodes. And yet, when these signs appear, the majority of people don't see them for what they are. Why? Because of human psychology. It's comforting to believe that tomorrow will look like today. If your investments have been going up for years, you start to think they'll go up forever. If your business is booming, you believe it will always be booming. This optimism bias is hardwired into us. It helped our ancestors survive by keeping them moving forward instead of paralyzed by fear. But in finance, it's a trap. That's why crises always feel sudden, even though they're not. The seeds of a crash are planted years in advance, watered by overconfidence, fertilized by cheap credit, and grown under the warm sun of public optimism. By the time the first real signs appear, the roots are so deep that pulling them out is almost impossible. Take the dot-com bubble of the late 1990s. The internet was changing the world, no doubt about it, but that truth was twisted into a frenzy where companies with no revenue, no product, and no realistic unrealistic business plan were valued in the billions simply because they had .com in their name. Investors believed they were on the ground floor of the future, and in a sense, they were. The internet did change everything, but timing matters. And when reality set in, trillions of dollars in wealth vanished almost overnight. Or look at Japan in the 1980s. The country experienced an asset bubble so extreme that at one point, the land under the Imperial Palace in Tokyo was said to be worth more than all the real estate in California. Stocks soared, real estate prices skyrocketed, and credit flowed freely. It seemed unstoppable, until it wasn't. The bubble burst in the early 1990s, and Japan entered what became known as the Lost Decade, a period of economic stagnation that lasted far longer than anyone expected. Here's the uncomfortable truth. The pattern is so consistent because it's not about numbers, it's about people. Human behavior doesn't change. The same emotions, greed, fear, hope, denial, drive markets today just as they did 100 years ago. And because we're wired the same way, we make the same mistakes. We ignore the signs. We tell ourselves it's different this time. We double down instead of pulling back. And then the bottom falls out. But the story doesn't end there, because once the crisis hits, a second phase begins. The scramble for answers. People look for someone to blame. Politicians, bankers, speculators, foreign governments, even mysterious conspiracies. But while these players may contribute to the timing or severity of a crash, the real cause is deeper. It's the cycle itself. It's the fact that success breeds overconfidence. Overconfidence breeds risk, and risk eventually leads to collapse. This is why crashes will keep happening, and it's why the signs will keep repeating, if you're willing to see them. The question is, how do you spot them early enough to do something about it? That's where the history lessons matter, because once you start to see the pattern, you realize it's not just about money. It's about power, psychology, and timing. The trouble with spotting a crisis before it happens is that the truth rarely shouts. It whispers. It hides in small stories buried deep in the business section, in a chart you barely glance at, in a piece of data that feels too boring to care about. And yet, if you collect enough of these whispers, they form a scream. The problem is, when you start connecting the dots too early, people look at you like you're paranoid. They call you doom and gloom. They tell you you're overreacting. History is full of people who saw the storm coming and got laughed at right up until the day it hit. Consider Michael Burry, the investor made famous by The Big Short. Years before the 2008 crisis, he saw the housing market for what it really was, a giant tower of debt held together by lies and wishful thinking. He pored over mortgage data, digging into the actual loans people were taking out, and realized they were toxic, adjustable rate mortgages that would explode in cost after a few years. Loans given to people with no income, no jobs, no assets. The so-called NINJA loans. On paper, the housing market was booming. In reality, it was rotting from the inside out. Burry tried to warn the big banks. They ignored him. He told investors to prepare. They resisted. His prediction was too early, too uncomfortable, and too out of sync with the happy narrative of the time. But when the collapse finally came, his doom and gloom view became the only view that mattered. That's the thing about financial disasters. The closer you are to the truth, the lonelier you feel. In the late stages before a crisis, optimism becomes the dominant religion, and anyone who questions it becomes a heretic. In 1928, economist Irving Fisher, one of the most respected minds of his time, famously declared that the stock market had reached a permanently high plateau. His voice was amplified in every newspaper and magazine. Meanwhile, a few quiet observers looked at the soaring prices, the debt-fueled buying, the speculative mania, and they knew it couldn't last. But no one wanted to hear them. The same was true in the months before the COVID-19 market crash. Early reports from Asia warned of a fast-spreading virus. A handful of analysts said it could disrupt global supply chains, trigger panic, and hammer the markets. But the dominant narrative was that it would be contained. Stock indexes hit record highs in February 2020, just 3 weeks before the fastest market drop in history. Here's what makes the warning signs so tricky. They almost never come in a dramatic cinematic package. Instead, they're disguised as normal news. In 2006, it was a few small lenders going bankrupt, names no one outside the industry cared about. In 1997, before the Asian financial crisis, it was the sudden collapse of the Thai baht, a currency most Americans couldn't even name. In 1929, it was a dip in steel production and a slowdown in car sales. Hardly the kind of headlines that spark panic. That's why spotting a crisis isn't about waiting for the big news. By the time it's on the front page, it's it's too late. The real skill is noticing the tiny fractures in the system, the things that seem irrelevant in the moment, but in hindsight look obvious. It's like hearing the first creaks of a bridge under too much weight. One of the most dangerous human instincts in this context is normalcy bias. It's the belief that because something hasn't happened in a while, or ever in your personal experience, it's unlikely to happen at all. If you've lived through 10 years of growth, your brain tells you that growth is the default. If your house has never flooded, you assume it never will. This is why so many people stay invested, keep borrowing, or keep expanding their businesses right into the teeth of a collapse. But history doesn't care about your personal experience. It cares about cycles. Economies, like seasons, have phases: growth, peak, contraction, recovery. And while each cycle looks a little different, the rhythm is the same. Every period of growth plants the seeds of its own destruction. The more confident people become, the more risk they take. The more risk they take, the more fragile the system becomes. Eventually, something snaps. In the lead up to the 2008 crash, one of the clearest, yet most ignored, signs was the explosion in something called the Case-Shiller Home Price Index. Home prices were rising at double-digit rates year after year. Wages were not. People were paying more for houses than they could possibly afford, but no one cared because you can always sell for more later. It's the same logic that fueled the Tulip Mania in 17th century Holland, when people traded their homes and life savings for rare tulip bulbs, convinced the price would never fall. It always falls. And here's where it gets truly dangerous. Before every crisis, there's a moment when the smartest players quietly start to exit. They don't make a big scene. They don't shout from the rooftops. They just begin selling assets, reducing debt, moving to safer investments. They do it slowly so as not to spook the crowd, but if you look closely, you can see the footprints. In 2007, some hedge funds began quietly unloading mortgage-backed securities months before the rest of the market caught on. In 1929, a few industrial magnates converted their holdings to cash while the public kept buying. The challenge is that the public doesn't see these moves in real time. We find out months or years later after the crash when the insiders look like geniuses. During the moment itself, all we hear is the noise of the crowd, and the crowd is usually still cheering. That's why one of the most chilling quotes in financial history comes from a banker named Charles Kindleberger. There is nothing more disturbing to one's well-being and judgment than to see a friend get rich. In other words, even if you sense danger, it's hard to sit out when everyone around you is making easy money. You feel left out, foolish, even jealous. And that emotional pressure can drag you right into the path of the oncoming disaster. But here's the twist. While the signs are consistent, the triggers are not. The actual spark that sets off a crisis is often unexpected. In 2008, it was a wave of mortgage defaults. In 2000, it was a sudden realization that most dot-com companies were worthless. In 1973, it was an oil embargo. In 1997, it was a currency collapse in Thailand. You can see the dry brush building up for years, but you don't know exactly what match will set it ablaze. And that's where preparation comes in, because while you can't predict the exact day a crisis will start, you can read the climate. You can tell when the system is brittle, when debt is excessive, when valuations are stretched, when the crowd has lost touch with reality. That's when you know the season is changing. The leaves may still be green, the sun may still be shining, but winter is coming. Imagine it's the summer of 1929 in New York City. The air is thick with heat and optimism. The jazz clubs are packed. Automobiles rumble down the streets in greater numbers than ever before. Every week, a new skyscraper seems to pierce the sky, each one taller than the last, as if steel itself is racing against gravity. The newspapers are filled with stories of fortunes being made overnight on Wall Street. Secretaries, shoe shiners, and taxi drivers all talk about their latest stock picks. The market has been climbing for nearly a decade, and the idea that it could stop feels as ridiculous as saying the sun won't rise tomorrow. This is the peak of what economists would later call the Roaring '20s, and it is euphoric. Radio, cars, consumer goods, technology is changing daily life, and everyone wants to be part of the future. Buying stocks on margin, borrowing money to invest is not just common, it's almost expected. Why risk your own cash when you can double or triple your buying power with borrowed funds? As long as the market keeps going up, it's a the perfect plan, but if you looked closely, cracks were already forming. Industrial production had started to slow, car sales were slipping, farmers were drowning in debt from years of overproduction. In Europe, economies were struggling to recover from the devastation of World War I. These were whispers in the background, small headlines buried under the more exciting stories of new inventions, celebrity gossip, and endless market gains. On September 3rd, 1929, the Dow Jones Industrial Average hit its peak. No one knew it then, but that day marked the top. Over the next several weeks, the market began to wobble. Prices didn't collapse, not yet, but they started moving sideways, even drifting down in some sectors. A few cautious investors began to pull back, but most stayed in. They told themselves it was just a healthy correction, the kind markets always have before going even higher. Then came October. On Thursday, October 24th, Black Thursday, the market opened to a flood of selling. Prices dropped so quickly that ticker tapes fell hours behind. Crowds gathered outside the New York Stock Exchange, straining to read the latest numbers posted on chalkboards. Banks and brokers pooled money to try to stop the fall, and for a moment it worked. The market stabilized on Friday, but the following week brought Black Monday and Black Tuesday. 2 days of panic selling that wiped out billions in wealth. By the end of the month, the market had lost nearly half its value. Over the next 3 years, it would lose almost 90%. Banks failed, businesses shuttered, unemployment soared. The optimism of the roaring 20s vanished, replaced by breadlines and dust storms. Now fast forward nearly 80 years to 2008. The setting is different. Suburban houses instead of skyscrapers, smartphones instead of radios, but the rhythm is eerily familiar. In the early 2000s, interest rates were low, credit was easy, and home prices were climbing like they never had before. Real estate agents said it was the golden age of property. Ordinary families bought bigger homes than they could afford, convinced they'd just refinance later. Investors bought multiple properties, planning to flip them for quick profits. Banks, eager for more loans to sell, created mortgages that required little to no proof of income. On the surface, it seemed like a miracle. Home ownership rates hit record highs. Construction boomed. TV shows glorified house flipping. If you questioned it, you were told you just didn't understand the new economy. After all, housing was different from other markets. They're not making more land, people said. Real estate always goes up, but beneath the surface, danger was brewing. Many of the loans being issued were adjustable rate mortgages with low teaser rates that would reset much higher after a couple of years. Millions of borrowers were on track to face payment shocks they couldn't afford. The banks didn't care. They weren't planning to hold the loans. Instead, they bundled them into complex securities and sold them to investors around the world, each stamped with a credit rating that implied they were almost risk-free. In 2006, a few small cracks appeared. A handful of subprime lenders went bankrupt. Home sales slowed, but just like in 1929, the majority shrugged it off. The big investment banks, the Federal Reserve, and most economists said the problems were contained. By 2007, the cracks became fractures. Home prices stopped rising, then they started to fall. Homeowners who had counted on refinancing found themselves underwater, owing more than their homes were worth. Defaults surged. Those safe mortgage-backed securities began to lose value. Banks that had been leveraged 30 to 1, meaning they held $30 in assets for every $1 in equity, suddenly faced catastrophic losses. In September 2008, Lehman Brothers collapsed, triggering a global panic. Credit markets froze. The stock market plunged. Millions lost their jobs. Entire retirement accounts were wiped out. Governments scrambled to bail out banks and stabilize the system, but the damage was done. When you put 1929 and 2008 side by side, the similarities are striking. A period of euphoria, easy credit, overconfidence, ignored warnings, small early failures, official reassurances, and then the fall. Different centuries, different assets, different technology, but the same human psychology. And here's the uncomfortable part. We've seen the same signs again in more recent years. Asset prices climbing to record highs, retail investors flooding into markets with little experience, borrowing to invest, the rise of speculative fads, whether it's dot-com stocks in 1999, meme stocks in 2021, or cryptocurrencies with no real-world utility. The specifics change, but the cycle doesn't. In the next stretch of our journey, we're going to to zoom out even further, looking at crises that go back centuries, even millennia, because when you see how deep this pattern runs, you start to realize something that can feel both empowering and terrifying. The next crisis is not a question of if, it's a question of when. And the signs, they'll be there if you're willing to see them. Picture this: Amsterdam, 1636. The canals are quiet under a thin layer of ice, but inside the taverns, the air is thick with smoke, laughter, and the sound of deals being made. Not deals for ships or spices or land, but for flowers, specifically tulips. Tulips had arrived in Europe less than a century earlier, and their exotic beauty had captured the imagination of the Dutch elite. Rare varieties with streaked petals, caused by a harmless virus, became status symbols. The rarer the tulip, the more it was worth. At first, tulip trading was a pastime for the wealthy, but as prices climbed, more and more people got involved. Merchants, craftsmen, even farmers, they all saw an opportunity. Soon tulips weren't just flowers, they were contracts. People began trading futures, agreements to buy bulbs months in advance at a fixed price. You could lock in a bulb today and sell the contract for a profit before it even bloomed. It was quick money without having to plant a single seed. Prices skyrocketed. One famous variety, the Semper Augustus, reportedly sold for more than the cost of a canal-side mansion. People traded and retraded the same bulbs on paper, sometimes dozens of times before they ever changed hands physically. And here's the eerie part. Just like in 1929 and 2008, the signs of trouble were visible before the crash. The most expensive bulbs weren't being planted anymore. They were just circulating as speculative paper. The average person couldn't afford the top varieties, so they turned to cheaper ones, which also began rising rapidly. Tulip clubs formed where locals would gather to speculate over drinks, and the language changed. People started talking about sure bets and can't lose investments. Then, in February 1637, the market shuttered. At an auction in Harlem, buyers simply didn't show up. One failed sale triggered another. Prices fell. Contracts were abandoned. Within weeks, tulip values collapsed by over 90%. Fortunes evaporated. Lawsuits flew. Some traders went bankrupt. Others refused to honor contracts, arguing they were just games of chance and not binding agreements. The Dutch economy survived. Tulip trading had been more of a speculative fever than a systemic risk. But the lesson was clear. Human enthusiasm, when mixed with easy money and social pressure, can turn almost anything into a bubble. Now jump forward to the 19th century. In the 1840s Britain, it wasn't flowers, it was railroads. The Industrial Revolution was in full swing, and rail technology was transforming the nation. Investors were intoxicated by the idea that a railway boom would connect every corner of the country and generate endless wealth. Shares in railway companies became the hottest assets of the era. Newspapers published glowing reports. Promoters exaggerated potential profits. Ordinary families poured their savings into rail stocks, convinced they were buying into the future. Parliament even loosened regulations to encourage the frenzy. Then came the inevitable. Many of the proposed lines were never going to be profitable. Costs spiraled, speculative capital dried up, share prices collapsed. The railway mania ended with widespread bankruptcies and financial ruin for thousands of small investors. Even earlier, in 1720, there was the infamous South Sea Bubble. The South Sea Company had promised to take over Britain's national debt in exchange for a monopoly on trade with South America. The pitch was irresistible. Investors could profit from exotic goods and from the financial engineering of the debt swap. The stock soared. People borrowed to buy shares. Pamphlets promised untold riches, but the company's trade prospects were vastly overstated, and political corruption fueled the hype. When reality set in, the crash was brutal. The fallout shook the British economy and destroyed public trust in financial markets for decades. If we zoom out even more, Ancient Rome, 33 AD, we see a similar pattern. The Roman banking system was rudimentary compared to ours, but credit played a huge role in commerce. A series of defaults triggered a liquidity crisis. Land prices collapsed as indebted senators and merchants were forced to sell. The Emperor Tiberius had to step in with an early form of a bailout, lending money to stabilize the system. Different centuries, different cultures, different technologies, yet the cycle repeats. A new opportunity emerges. Tulips, railways, housing, tech stocks. Credit floods in, making it easy for more people to participate. Optimism becomes euphoria, and warnings are dismissed. Small cracks appear, but the crowd ignores them. Confidence collapses, triggering panic. The most unsettling part, these cycles don't require complex modern finance to occur. They require only three ingredients: markets, human greed, human fear, and the belief that this time is different. And that belief, that seductive whisper that we've outsmarted the past, is always the last step before the fall. In the next part, we'll shift from history to the mechanics of modern pre-crisis signals, the hard data and patterns that tend to appear right before everything unravels, but we'll translate it into plain English so anyone can spot them without a finance degree. If history shows us that crises are inevitable, data shows us how they sneak up. The problem is, by the time the average person feels the pain, job losses, stock crashes, bank failures, the damage has already been done. But almost every major crisis is preceded by a cluster of signals. They're not mysterious, but they are often ignored because they don't fit the everything's fine narrative. Let's break down the big ones. 1. The credit boom that turns into a credit glut. One of the most reliable pre-crisis signs is a rapid expansion of credit, loans growing much faster than the overall economy. Why this matters: when debt piles up faster than income, it creates fragility. As long as everything keeps growing, it feels fine. Businesses expand, consumers spend, banks collect interest. But when something, anything, interrupts the flow, the whole system seizes. Example: in the years before 2008, US household debt as a percentage of GDP hit record highs. In Asia, before the 1997 financial crisis, corporate debt levels were exploding, much of it in foreign currency. Even the Great Depression had its own credit binge in the late 1920s, fueled by margin loans for stocks. Key takeaway: when credit growth far outpaces GDP for several years, history says the clock is ticking. 2. Asset prices detached from reality. When prices for assets, stocks, houses, cryptocurrencies, even collectibles rise much faster than the incomes or rents or profits that justify them, you're looking at a bubble. You can measure this in simple ratios: price to earnings (PE) for stocks, price to rent for real estate, market cap versus actual adoption for crypto. The red flag: if those ratios go into territory far above historical averages and stay there, the market is in "it's different this time" mode. 3. Yield curve inversion. This one sounds technical, but is actually quite simple. Normally, long-term interest rates are higher than short-term rates because lending money for longer is riskier. When that flips, meaning short-term rates are higher, it often signals a recession is coming. Why? Because it means investors expect the central bank to cut rates soon to fight a slowdown. In the US, an inverted yield curve has preceded every recession in the past 50 years, with very few false alarms. 4. Surges in risk-on speculation. Before big crashes, markets often see a spike in high-risk, high-fantasy investments. Penny stocks in 1929 IPOs with no revenue in 1999. Meme stocks and joke cryptocurrencies in 2021. These fads aren't usually the direct cause of a crisis, but they're a symptom, a sign that cheap money and optimism have reached unsustainable levels. 5. Declining business and consumer confidence. When confidence surveys start to dip, even while markets are still strong, it's a hint that the foundation is weakening. People may still be spending, but they're starting to feel uneasy about the future. 6. Corporate profit margins. Peaking historically, profit margins tend to hit record highs before a downturn. When they start shrinking, companies may respond with cost cuts, often meaning layoffs, which can accelerate the slowdown. 7. Rising delinquency rates. Before a major crisis, certain pockets of the economy start showing stress. In 2007, it was subprime mortgages. In the 1990s Asian crisis, it was corporate loans. Today, it could be auto loans, credit cards, or commercial real estate debt. The pattern: defaults start in one sector, then spread as lenders tighten credit, causing more failures elsewhere. Why these are ignored? Optimism bias. People want to believe good times will last. Incentives. Politicians, companies, and media often have a vested interest in keeping the mood upbeat. Complexity. Signals can be masked by noise. It's easy to dismiss a red flag as just a blip. Here's the uncomfortable truth: by the time all of these signals are flashing at once, the crisis is usually unavoidable. The crash may not happen tomorrow. Sometimes the euphoria lasts another year or two, but the groundwork has been laid, and that's why understanding them is empowering. You won't be surprised when the headlines finally scream panic. In our final part, we're going to tie this all together, showing how you can recognize the pre-crisis script in real time, and how to act before the crowd even realizes something's wrong. Let's imagine something for a moment. You're standing in a crowded street, and everyone around you is laughing, buying, spending, celebrating. The stores are full, the ads are glowing, politicians are on TV talking about record growth and a bright future. And then, in the middle of it all, you hear a faint, distant sound, like a siren far away. Most people can't hear it. Some hear it but shrug it off. But you stop. That siren is the set of patterns we've talked about today. It's the credit binge, the asset bubble, the risk mania, the small cracks that no one else wants to admit they see. It's the same siren that's played in Amsterdam in 1636, in London in 1720, in New York in 1929, in Tokyo in 1989, in the US housing market in 2007, and in every corner of the world before the next big downturn. And here's the part people don't want to hear. There's always a calm before the storm. It's that deceptive period when things still look fine, but under the surface, the system is straining. The dam hasn't broken yet, but the cracks are widening. Most people will wait until the water bursts through before they start running. By then, it's too late. Why this matters to you: crises aren't just headlines or history lessons. They change lives. They decide who keeps their home and who loses it, who keeps their job and who's out on the street, who turns a crash into an opportunity, and who watches their savings vanish. And the difference almost always comes down to one thing: whether you saw it coming, what you can do. No one can predict the exact day or month a crisis will hit. That's not how this works, but you can recognize when the script is unfolding. When all the signals start aligning, that's your cue. Maybe it's the time to pull some money out of risky investments. Maybe it's the time to build a cash buffer. Maybe it's the time to learn new skills so you're harder to replace if layoffs hit. It's not about panic, it's about preparation. Because here's the truth: crises are not just endings, they're resets. They sweep away the illusions and expose the reality. And those who are ready, who see the signs before the crash, often come out stronger on the other side. So the next time you hear that distant siren, that faint echo of history repeating, don't just keep walking with the crowd. Stop, look around, ask yourself, what's really going on here? Because if history has taught us anything, it's this: what happens before a crisis is always the same, and what you do in that moment can change everything.